Tonight we're going to be talking about virtual assets and taxes, and I am not a tax expert. But we do oftentimes in our practice get a lot of questions that come in about different tax considerations from the businesses that we worked with. And so I thought that it was important to cover that off as a topic and to make sure that there's good information out to the community rather than from folks that maybe have an accounting degree from Reddit. Some offense intended. So here with me, I've assembled some of the finest accountants, lawyers, consultants, and folks, I think, in the country. But I wouldn't be a good compliance nerd if I didn't give a few disclaimers. So in their capacity tonight, while they are lawyers, accountants, they're not your lawyers. They're not your accountants. So please don't interpret the things that they're saying as tax or legal advice. There's a lot of nuance in different situations, and that nuance can make all the difference in the world. If you do need tax or legal advice, I would highly encourage you to get cards, exchange information after the panel. And there is going to be some time after the panel for audience questions. We also have from Rise Wallet a couple of $25 Rise Wallet cards to get some Bitcoin from Rise Wallet for folks that ask great questions. So we will give those away at the end. So from there, Canada Revenue Agency has issued some guidance on cryptocurrency. So they've issued guidance for cryptocurrency users, for tax professionals on their website. And for my AML compliance nerd friends that are here, tonight we're going to use the terms virtual currency, which we use in anti-money laundering legislation, and cryptocurrency, which is used more commonly in the tax legislation, interchangeably. I know there are some people that will argue that there's a lot of nuance between those two terms, so forgive me for that. That's what we're rolling with for tonight. I'm going to start with Sarah, and as an opening question, just to introduce yourselves, tell us what you do in the virtual asset space and what keeps it interesting for you.
Okay, so there we go. So I'm Sarah Noftell, and I'm a tax partner specializing in sales taxes at Grant Thornton. So that would be all the taxes that are not income tax. And then further specializing from there, I spend a lot of time in the financial service space dealing with banks, insurers, and also now those in the virtual currency space. My experience tends to have been more with miners and entities setting up in Canada to mine different types of cryptocurrency and dealing with importing equipment in to do that and those sorts of things. Yeah, so that's me, and that's what I do. What keeps it interesting? Like anything consulting related, every question is different, every client is different, and finding an elegant way to solve a problem is what keeps me going. So that's what I do.
Thank you. Zvi?
Hi, my name is Zvi Halpern-Shavim. I'm also a sales and commodity tax lawyer at Blake, Cassels and Graydon, which is a law firm. And I come to cryptocurrencies basically just the same way that I approach any industry. I work across industries, financial services, real estate. Cryptocurrency kind of fits within the financial services bucket. And I just find it interesting because it's a new development. There's so many new developments in technology and in tax legislation and administrative guidance from the CRA. And anytime that there's something interesting out there, I like to chase it. I just find it interesting to sort of chase things down and sort of solve the puzzle as best I can from beginning to end. So that's my interest in cryptocurrencies.
Hi, I'm Matthias Millett. I'm a tax partner at Osler, Hoskin & Harcourt, and I work mainly with institutional investors and asset managers, hedge funds, venture capital funds, and private equity funds. And I think my interest in cryptocurrencies is very similar to theirs. Anytime we find a new financial reality, commercial reality that we can apply concepts to, it gets quite interesting because they mutually illuminate each other or indicate dark spots and gaps. And certainly this area is full of those. And as a sideline, I'm also interested, as an investor in cryptocurrency, though not as a successful one. But anyway.
So my name is Mo Yang. So a bit of my background. So I started actually, working for this company, a real business, and they started trading cryptos as part of their operation. That was probably 2-3 years ago, and that's how I got started. So essentially, the business was, if I remember correctly, making close to $10 million in sales. It was a very successful web-based business, and they were collecting 2-3% of their sales in Bitcoin and Ethereum and some sort of other currency. So I came in and had to actually implement a hedging program for them. Was actually trading futures. So that was when I started learning a bit more about crypto and opening an account on exchanges and the application for a real business. So most recently, I've been running the family office that actually owns Polymath. So for those who don't know what Polymath is, it's a tokenization platform. It's one of the better known company in Toronto and Canada, and they focused on essentially a SaaS business model. They focus on offering tokenization services to other businesses who are trying to tokenize, who needs the support. And as part of this company, I run CFO function, so that means a lot of tax issues, managing multiple wallets across exchanges, across cold, hard wallets. So I see all the challenges and all the flexibility on the inside side of things, so that's really interesting to me.
Excellent. So I want to start with a question about tax and just in terms of how cryptocurrency is treated. CRA's guidance document indicates that cryptocurrency transactions can be taxed as either income tax or as capital gains. How do you know what applies?
Yeah, so that's a fundamental distinction in income tax law. And it actually, something that's interesting is that it makes an assumption that both the CRA and the IRS make, which is that when you have a Bitcoin, an Ether, or whatever kind of coin you have, that what you own is you own property that is capable of being sold and acquired, and therefore has to be classified as either being acquired on income account or on capital account, which I'll talk about in a minute. But I think it is worth pausing a moment, because as we delve further in the questions, talking about different kinds of tokens, this question of what is a digital asset? Is it money? Is it property? Is it something else? Is something worth we would never get through these questions if we kept interrogating this at that fundamental level, but I think it's worth saying a couple of words about it. And someone who's thought quite a bit about this is sitting right to my right here, so if I could ask you to speak to that.
Just very briefly, Matthias is referring to an article that I wrote, and Amber sent it as a link, just questioning whether Bitcoins, we were thinking about Bitcoins at the time, whether Bitcoins should be characterized as property, based on if you think about how a Bitcoin is created, what is it that you're doing in order to own a Bitcoin? Well, you're running software. Everybody else is running the same software. Who owns, but other people are running, not everyone, other people are running the same software. There's a protocol. And that protocol says that the Bitcoins are going to be transferred in a certain way, and they're going to be owned by people who are stated to, who a certain ledger that's distributed publicly says own the Bitcoins, and everybody's going along with this. And it's sort of in the nature of a social custom, in the sense that none of the people who are participating in this system have any legal relationship to each other. There's nobody saying, there's no contract between the people who are running the software, and there's no requirement, in fact, to run the software in that way. It just is, the ledger is tracking as Bitcoins the things that the software say are Bitcoins. And so we asked the question whether it really is appropriate to call Bitcoins property for GST purposes and for income tax purposes. If you're going to be thinking about, who would you sue if you wanted to get your Bitcoin? And somebody asked a question a bit later down in the chain of questions about forks, which really gets to the fundamental issue. if somebody chose to run a different software protocol, for example, and they were able to convince a whole lot of other people to run the software protocol differently, you might not have anything. And so I think it is worth the question of whether, right, it's worth asking the question of whether cryptocurrency should be considered property. That said, and Matthias pointed out that this is a rabbit hole to go down, all of the tax authorities do call it property, and they tax it as if it is property. And so I think at that high level, it's worth saying that, you know, we should bracket that point and sort of understand that it's there, but we're going to continue talking about cryptocurrencies as if you have them, even though there may be an issue with that, and just sort of to be aware of that.
Thanks, Fee. That's very helpful. So, assuming it is property, like any other property, when you exchange it, when you dispose of it, to use a different meaning of fork, there's a fork basically. Either it's going to be treated as, let's say your profit on the sale is $100 Canadian on a sale of coin. When you translate into Canadian dollars, you know. Is that profit to be taxed as ordinary income, meaning that if you're taxed at a 50% rate and you made a $100 profit, your tax is $50, or is it going to be taxed as capital gain, such that you take 50% of that $100, and now you have $50 of income, and you tax that at your 50% rate, such that you're paying $25 of tax, and then conversely on the loss side. And the losses have different treatments. And so that's what that means when CRA says that. And then the question is, how do you distinguish between those two? And it's it's a combination of a facts and circumstances test with some case law principles. But the basic idea is, think of a hedge fund or a day trader speculating in cryptocurrency, being highly savvy about the market, possibly using leverage, making frequent trades. That's going to be treated as considered a business by the CRA. It's going to give rise to ordinary income. The other extreme would be a hodler, someone who's just holding long term, not watching the market and getting in and out of different currencies. That person would probably succeed in claiming capital treatment.
Yeah, so just to add to this conversation, thank you for the details here. So I happen to run a small consultancy shop, and we do consult with different entrepreneurs, small business on their legal tax issues. And whenever they ask me that question, oftentimes they're trying to achieve the lowest tax rate, right? They're trying to have the treatment that's a bit more favorable on the perspective of taxation, and oftentimes clearly it's unfortunately capital gains. But the way I look at this is, just to give you guys a framework on where to go. Initially, we look at your intent. Like, if you want to, do mining, if you want to actually actively pursue a business opportunity, it's pretty simple. If you want to be a miner, if you want to dedicate your time, you're going towards active. And then you look at what happens during the operation, 6 months after, a year after. For the most part, a lot of clients pivot and do something else. The market changes. So really the true nature of your transaction 6 months into it will determine as well if you are really, what you are. And for the most part, if you do this as a hobby, you might get some sort of, way out of this taxation issues. But for the most part, you also have to look at velocity. So if you're frequently trading, so if you're, trading 2-3 times your net worth in a year, a lot of trading, you're always in front of a screen, it is what it is. It looks like you are a very active trader, and the treatment will change if you're personal or a corporation. So I will look at those 3 things. I will look at your intention. I will look at what really happens within your business. Some people abandon their project and focus on something else, and you can, easily make your own determination and make your own case point, which is extremely fair. And also the volume and the velocity. If you trade often, if you churn, if you generate big volume, most likely than not, you're very active. So it's going to be ordinary income. It's going to be active income for tax purposes. And usually, for the most part, that's going to be a higher tax rate.
Just out of dire curiosity, as someone who isn't a tax person at my core, what does it mean to say if you trade often? Is there a number, or is it very case by case?
Yeah, it's case by case. I mean, like the way he put it, if you're in front of a screen all the time, right? Like, and not just because you're a nervous long-term holder, but you're actually going to act on market cues frequently. There's not really a bright line number.
Yeah. Yeah, if you are a Bitcoin maximalist and you're adding to your portfolio every 2-3 weeks, you're adding to your position, you're not churning a lot, so take a look at the turnover, right? If your portfolio is $50,000 and you're making small trades of $1,000 to $2,000, it seems like you're just a part-time kind of guy, right? So the turnover is a really good indication. Very active traders with very big exchange accounts are going to have upward of 50 to 100 tickets, and the volume is going to be 3-4 times the multiple of your net worth. I mean, it's clearly that you are focused on trading, right?
And just one thing that could be helpful to some investors is the courts have recognized that you can hold blocks of one type of, let's say securities, just to keep it simple. Like you can hold a block of a certain security as a long-term investment and keep some other over here as inventory, trading inventory. So if you wanted to have a long-term holding, but you're also interested in more active trading, you could consider, having segregated wallets and holding stuff, on different digital exchanges, digital wallets on exchanges, et cetera, and make that case.
Yeah, and so another good example here would be to take a look at what happens in real estate, right? Oftentimes, if you are, buying and selling and churning properties 2, 3, 4 times a year, the government is going to say you are a flipper. If you hold your property for over a year, it seems like sometimes it's a good benchmark. You get away with paying capital gain and getting the exemption sometimes for your principal residence. So it's very similar, I think, to real estate, and how often you would trade. A year would be, 6 months to a year of holding would be a good indication.
Fair. In the guidance, it talks about cryptocurrency-related transactions being treated as barter transactions. What does that mean, and what's the implication of that?
Yeah, I can take that. So, looking at it from a GST, HST perspective, but even more broadly, when we think about a barter, we're trading something for a different thing. So, for example, I might provide an accounting service in exchange for a lawn mowing service. No money is being transferred, but I'm providing something to somebody and they're providing something to me. And from a GST perspective, that would be treated typically as 2 separate transactions. So I sold something and I would presumably charge my HST on that. The other person sold something to me and they should charge their HST. From a cryptocurrency perspective, if one of the things being traded is an accounting service and the other thing coming back to me instead of dollars is Bitcoin, it doesn't change what I have supplied or my obligation to charge tax on what I supplied and remit that. So the fact that I'm being paid in Bitcoin, I'm still selling something that I have an obligation to collect tax on. So it's just kind of recognizing that there are still 2 transactions. So then what we think about is the other side of it. So the person that is supplying the Bitcoin, do they have a remittance obligation for what they've supplied to me? And that's been an area of some question and controversy until May of this year. So you had mentioned that there was a CRA document dealing with the taxation of cryptocurrency. It actually is dealing with the income tax treatment of cryptocurrency. And for a sales tax perspective, we have a new proposal, at least, and this is just proposed legislation, proposing to treat cryptocurrencies, if they meet certain criteria, like a financial instrument. So close to money, but not quite money. I don't know if you want to elaborate. You have all the definitions here. If you want to talk about it.
I think that's good for now. I mean, if we're talking about barters, I don't know if there's an income tax point that should be made about the barters.
Yeah, I mean, I guess there's just the thing that's sometimes hard intuitively for people to get around, which is when you pay money to get something, you think of the other person as selling something, you don't think of yourself as selling something. And for income tax purposes, using Canadian currency, there's no consequence to your parting with your Canadian dollars. It'll be a measure of how much tax cost you get in the asset you take back. But given the tax authorities, the IRS and the CRA's view of cryptocurrency transactions as barter transactions, you have to sort of get around the idea that, actually they're treating you as, when you use cryptocurrency as a means of exchange, that you're actually disposing of something. You're having a taxable transaction, it's not just the seller of the thing to you that's having a taxable transaction. You're having one because of the medium of exchange that you're using. So I think that would be the main thing to add. The one other thing to add, without going to details, is that given the way that the case law has described how you measure the profit that somebody makes in a barter transaction when they give something up, compared to how they measure what that person's cost is in the new property they take back, you can have a real discrepancy between those two amounts, given the volatility of crypto, if you enter into what we call an executory contract. That is a contract to have an exchange in the future, more than not today, but tomorrow or 2 weeks from now. So that's just something to watch out for.
Yeah, sorry, go ahead.
Sure, thanks. I was just going to add one thing, which is I think the language of barter ties into the way that the CRA refers to cryptocurrencies, referred to them as commodities. Right? That was their language. So once you've already considered it to be a commodity, it's like you're trading gold, but it's precious metals. So cows, right, or wheat for whatever it is you're buying, pizza. So that's the way that they've been thinking of it. It's like you're selling a commodity in exchange for the purchase of that other commodity.
Yeah, I have a very interesting angle here. I see all those barter transactions within wallets where you would, sell your Bitcoin to buy some Ethereum, for example. And really the consideration here is the Bitcoin. You're buying a new financial instrument. Again, HST laws and HST rules, it's not my forte, but I really wish the CRA would, put its boots on the ground and say, that consideration is actually a financial instrument, and it doesn't really generate HST. Because to me, it's kind of like from Canadian dollars to US dollars. Yes, you are buying US dollars, but you're not charging HST. So my guess is in the future they'll clarify this position. And also from a barter perspective, we've analyzed this problem because the market was so frothy back in 2017. If you were buying altcoin, Ethereum, and participating in pre-ICOs, as a matter of fact, you are creating a cost base and you are realizing your gain. So we were stuck with huge issues on realized capital gains and having to record or accrue losses right back in Q1. So just to simplify, it does create some tax issues, but every single time you go from Bitcoin to Ethereum to any other crypto, it is a taxable event, and you do have to reestablish a new cost base for your purchase, and you have to realize some sort of gain on the consideration, right? So that's something that's really challenging for us in a very hockey stick kind of market where, from November to December, it could go from 10,000 to 25,000. You've actually never converted to fiat, but as a matter of fact, based on barter rules, you actually owe an incredible amount of taxes. So those challenges, we've seen often.
You mean if it goes from 10 to 25 and you exchange the appreciated cryptocurrency for another cryptocurrency?
Yeah, absolutely. Yeah, so back when the market was very frothy,
Or for a coin on an initial coin offering or something?
yeah, and
Okay.
those were going, up to 5, 10x and 20x on launch, and even though it's not really realized, the owner was stuck with a higher valuation, a higher tax cost base, and they just didn't have the liquidity. And in Q1, Q2, a year after, they were actually in a losing position. So it does create challenges. Yeah.
So let me jump into just another question from that losing position in particular, because I've read very different things about losses. And so we all know that there can be capital gains, but can there be capital losses, and when would you declare a capital loss?
Yeah, so basically, so there's two buckets. There's capital losses, and they're called non-capital losses or ordinary losses. And it's really an aggregate thing. Like, you take all your capital gains for the year, you take all your capital loss for the year, and if you have a net amount, then you've got a loss for the year. And so you do get to apply your losses from selling capital property or a property held on capital account against your capital gains. So that's within the year. Then if you have an excess for the year, you can carry that back to your prior 3 years. So you can file an amended return if you had capital gains and reduce your capital gains and get a refund. Or you can kind of keep them around, remember them, and carry them forward indefinitely. But they can only ever be applied against capital gains.
Right, but in that situation that Mo was just talking about, so if you'd had a big gain, and then you ended up holding an asset that was worthless, and you sold it, you then have a loss that you can apply against your prior
Correct.
year. So there's a saving grace, if
Correct.
you will.
Yeah, that's a good point. Yeah.
If there's a disposition
Yeah,
there.
yeah, that's right. Yeah. And then non-capital losses can be applied against any kind of income. So they can be applied against capital gains. So they're kind of more valuable in that way. And they can be carried back 3 years if you have a net non-capital loss for the year, and carried forward 20 years. So that's the general rules. And so cryptocurrency losses determine whether it's on income or capital account, then they go into the different buckets.
How specialized does your practitioner need to be to carry back something like that? I'm assuming this is not an H&R Block function.
It's actually, I mean, any accountant that does returns for individuals with a little bit of complexity would be able to do that. I think it's sweet. I mean, or Sarah, you're actually.
Sarah's
Yeah,
Talk to her about that.
I am an accountant. Yeah, I don't know if I would go as far as H&R Block, but certainly, yes, any of the accounting firms would be able to handle that. We should probably also just clarify to your point, Mo. There has been a finance release this year dealing with the treatment of what we're now calling virtual payment instruments, which I find a little awkward to say because it's not the vocabulary that any of us are used to. But finance has chosen to refer to these as virtual payment instruments, and the proposal is that those will be considered financial instruments, which theoretically can be bought and sold on an exempt basis for GST, with the caveat that the definition is a page long as to what actually qualifies as a virtual payment instrument for GST purposes. But conceptually, it's essentially a digital representation of value, so like a Bitcoin that is existing only on a public exchange. And it excludes a few things. So public ledger, yes. Yes, it says publicly distributed ledger on the page. So it excludes certain things. So it excludes that type of property that can only be exchanged for certain specific rights or property or services. So this is going to exclude your maybe Canadian Tire money if you have that virtually, because that can only be exchanged for certain specific things. And it excludes payment instruments that can only be or primarily are for use within gaming platforms or certain loyalty programs. So clearly they're intending to capture your Bitcoins and your Ethereum, things like that, but not so much your Pokecoins and your Canadian Tire money and the more limited use types of payment instruments. But when you use the word primary in legislation, that suggests that you could have property of this kind that is used for more than one purpose, and that's where you have to get into really what is the primary intended use of that type of currency, and there could be some gray area here. If you want to add to that.
Yeah, good point. Yeah, it's still very gray, right? How they define.
It's very gray, and
yeah.
it doesn't. It addresses the instrument itself and where that will be kind of categorized and defined in the Act. It says it's property, so regardless of any philosophical debate for GST, we will treat it as property in all the ways that are relevant for that legislation. This proposal does not in any way address what miners are doing. So are they providing a service? Who are they providing that service to? So, is what they're doing taxable? They receive a payment of some kind for what they're doing. Who are they receiving that from? Should they be collecting tax from somebody? What do they do with the equipment that they're importing? Can they recover tax they pay on that? So there are more questions than answers, but it's a start. It is a step forward from where we were.
Good to know. So I have an interesting perspective from a client or investors from the past on the loss perspective. And so in general, it's a market timing thing. So if you invested recently in this overall bearish market, I would tell them, yeah, absolutely, you can take your losses, carry them forward. It's capital gain, so if you lost 50,000, you carry over 25, and you can it is actually a tax shield for you in the future. If you've done very well in 2017, and you've created some sort of tax base for the future, and now you're bleeding out in 18 or 19, yeah, you can absolutely use those losses. But obviously, there's still, I work with different projects. I see all kind of scenarios where, owners, would have lost their shirt, and they're being very selective about their losses. So that usually doesn't turn out well, because if you're being selective about your losses and you say, okay, well, I lost $500,000 in 2019, but I haven't declared, gains from the past, it's going to come in and haunt you. So, if usually when you are part of the 2017 bull run, you probably, would have done quite well, and there will be some sort of, tax paid, and you'll get some sort of rebate in this bearish market.
Fair. I want to come back for a minute just to the GST, HST question. So in terms of what we know now, when would you expect to have GST or HST on a transaction outside of the sort of products and services that would normally attract it anyway? So I understand that as a consultant, I charge HST or GST as applicable, and that's true whether I'm getting paid in Bitcoin or in dollars. Outside of that type of circumstance, when does it come into play?
I'll start. So first of all, I guess the first point is the new definition that Sarah just read is actually only legally effective as of May 18th, 2019. So if we think about the past, people who were selling cryptocurrencies that are now considered financial instruments under this definition, the implication, it's not certain, but the implication is that they might have been selling taxable things in the past. And so if you had a mining company that was mining Bitcoins as a business and selling them into the market, then they perhaps should have been charging GST, HST on those sales. You're looking at me like I'm nuts.
I just think that's something that a lot of us, myself included, probably don't want to hear.
Exchanges that were buying cryptocurrencies and selling them perhaps should have been paying and charging GST, HST on the cryptocurrencies that they were buying and selling. If they were buying from somebody who was a small supplier, like a retail seller who wasn't GST registered, then fine, they wouldn't be paying tax to that person because they're not registered. But if they were buying from another exchange or from a miner, somebody who's registered for GST, the way the rules look right now, and the way the CRA has talked about cryptocurrencies in the past as commodities, it looks like they were going down the road of saying that tax should have been charged on all of those transactions. Now, it would be very nice if this, the draft legislation, I'm pointing in front of me because I printed it out and I have it in front of me. The draft legislation is a proposal. It's not in law yet. Could change. Maybe it could have retroactive effect when it comes into effect, but I don't think anyone's mentioned that. So, the furthest back that anybody's talked about going is what they're calling the announcement date, which is the day after the announcement date, which is May 18th, 2019.
Interesting. So in that case, if it's not retroactive, is there a possibility then that CRA would go back and sort of look at people and have consequences
so where does
in
that
that
leave us?
regard?
Sorry, I know everyone's looking at me like I'm
practical side, I
crazy.
suppose.
Where does that leave us? In the past, before we had this draft legislation, the question is really, where were we? Were these things really commodities? Were they really taxable assets? And there's a number of different ways to find, I don't know if it's me, I'm sorry if it is, but to find an exemption for trading cryptocurrencies, or for selling cryptocurrencies or buying them, even under the old legislation. People were trying to do it before this legislation came out. The easiest one is that the definition of money includes currency of any kind. And so it is very possible that a court might be convinced that a cryptocurrency that's used as a currency is in fact money. And then you're there. It's exempt. When you buy and sell it, it's exempt from GST, HST. Notwithstanding that the CRA says it's a commodity like cows and wheat. So that's one easy way to, when I say easy, that's one easy conceptual way to think about how there could be an exemption for cryptocurrencies in the past before the draft legislation came out. People have tried other creative ways, I think. Different cryptocurrencies have their own unique characteristics, and so there may be other financial instrument aspects to them. One of them might be sort of like a debt security of some kind, perhaps, depending on its own individual characteristics, and you could fit into the definition of financial instrument before it was modified. But I think that's what you're looking at if you want to have those transactions exempt. Most people were looking at the definition of money at the time before this came out.
Yeah, so looking at the definition of money and currency that is recognized by an authority or a government somewhere in the world, and certainly I think other tax authorities might be a little further along that trail than Canada or the US. So, certainly I've seen ruling requests and submissions go in making that argument that it is money. It's a form of currency. Like you said, debt security is another argument that that may be valid in some situations. The other thing that we've seen is dealing with the non-resident rules and being able to relieve tax on transactions with non-residents, and structuring things in a way that everything is going through somebody outside of Canada. The challenge in this realm is that you don't always know who the other side of the transaction is, so it's difficult to prove that you're transacting with a non-resident if you don't know at all who you're transacting with. So that's part of the challenge there. But certainly the proposal is suggesting that it will be treated like a financial instrument, and what does that mean for the past? Do you have an audit risk? Will they act on that for the past? We don't know. Certainly there are arguments to put forward if that happens.
Okay. Did you want to add anything? No? Okay. I think that we've talked a fair bit about cryptocurrency, about virtual currency, and that's always near and dear to my heart. But I'm curious, because we have a lot of virtual assets that are being declared securities. So ICOs, STOs, IEOs, a security by any other name. And when that's the case, if it is from a legal perspective treated as a security, what difference does that make from a tax perspective?
So I think from an income tax perspective, it can really make a big difference to the entity that's. So if some enterprise is using tokens to raise capital, whether the tax authorities or a court would consider the tokens to be a type of security could make a big difference to that issuing enterprise. Because if you think about it as a form of crowdfunding, so crowdfunding, it's just a simpler model to start to think about this. Regular, kind of Kickstarter crowdfunding, the CRA says that if you take in money through that kind of a campaign, it's income to you, and that's not very good. Like if you're a business trying to get started, to have a tax event, to have the capital you take in be taxed is not great. So crowdfunding has now moved toward a security type model where platforms issue equity-like instruments or debt-like instruments. And then the nice thing is, if you're a corporation, let's say in Canada, you issue stock or you issue debt, the money you get from the investors is not income to you. That's a much better result. So what some have done is, the entity that's making the tokens available, some have just had it be an offshore entity or some kind of not-for-profit to avoid this problem of having an income inclusion when tokens are put out there. And but if the tokens can be respected as a security, and I think the CRA has made a statement saying it would be open to, in the right circumstances, treating a token as a security. I'm not aware of them having to date actually seen one that said, yeah, that is security.
Well, often I think you don't want the tokens to be securities sometimes because.
You mean for regulatory reasons?
Yeah.
Oh, absolutely.
Right.
Yeah, I was just answering the tax question.
Okay. Yeah.
Yeah.
Yeah, it is a bit of a catch-22 here, right? I mean, you don't want to fall into the regulatory basket of issues, but having or being a token also has its own issues, right? I mean, there's less clarity about HST. There's other challenges with income tax. So it is a catch-22.
Yeah, and just looking at this definition of the proposed definition for HST, the virtual payment instrument excludes property that confers a right, whether immediate or future, and whether absolute or contingent, to be exchanged or redeemed for money or specific property or services, or to be converted into money. So if you have a token that can be converted into a service or can be exchanged for something specific, and this is what Sarah was saying before, it's not a virtual payment instrument. It's more like a prepayment for that service or for that thing that you're going to be getting. If it's for money, if it can be
Or
redeemed
a
for-
redeemable security.
If it's redeemable for money or redeemable for something that's itself a financial instrument, then you could have an exemption for a different reason. But if it's redeemable for something that's taxable, then you've prepaid for something that's taxable. So I think that's what they're thinking of there with that exclusion. And it kind of gets to that crowdfunding point.
Go ahead, Joseph.
Google or whatever, you buy the value, and then when you actually use that value, that's when you get taxed. Is that what you're saying?
It's a bit like that, I guess, like a gift card.
Yeah.
I mean, gift cards have their own special rules for GST. If you're buying a token, I think sometimes it's usually contingent, right? If the company does well, or if something happens in the future, then you will be able to redeem these tokens in the future for a T-shirt or for something
Right.
awesome. But I think what they're saying with this definition to exclude those kinds of prepaid, it could be a contingent, right? So it's even sort of broader than the Amazon prepaid card, because an Amazon prepaid card isn't contingent. You paid for it and then you can use it to buy something at Amazon. With these tokens, you get the token and you may be able to use it in the future to buy something from the company that issued it, but you may not. Even with that contingency, they're saying it's excluded from the definition because you're prepaying for a contingent rate to get something. So that's the difference, but you're on the right track. It's the same sort of idea because of the prepayment. I think TTC tokens, if they ever tokenize the TTC.
Yeah. So maybe I can take it from here. So, sometimes it comes back to shareholder right? So when you tokenize a token, back in the day of the ICO golden age, you would raise millions of dollars, and what does that give you? Well, the investor really doesn't have any, equity. They don't have any. The company don't owe them anything. So, when there's investment form, they sign up, and all they get is this participation into this network, and the company promises that they'll be developing the community and the project, right? So from that perspective, you've invested $50,000 into the project, and there's really nowhere to put this on their balance sheet but to revenue, right? There's no shareholder loan component or shareholder equity component. There's no liability. Like a token would be a liability. You can use it in the future, so it's unearned revenue. So a token would be kind of like where you still have some right, you still have some, they owe you a service, you pay for it in advance. But to take this to the next level, it would be, full right. So you're investing in equity, and obviously you are a shareholder in full. So that goes back to on their balance sheet as if you were on the cap table, which is a lot different. You have your rights, and this is an investment for you, right?
We're thinking about it. We're like putting our heads together here.
Can we switch the token for the value on the Presto card? Because part of our definition relies on it being a digital representation of value. So that was our first debate, but the Presto card is it's holding the digital representation of value for the number of rides that you've prepaid, for example. We're debating what would happen if the TTC moved to a publicly distributed ledger.
Wouldn't it be excluded from, I don't, from what you guys mentioned about if it can only be used to acquire certain specific services?
Specific services. So
That
it's
would
going to
be-
be thrown back out there,
Yeah.
possibly, yeah. It's more like your Canadian Tire money, I guess.
If the TTC sort of expanded its ecosystem, so you could get more things using the Presto card points, then
Scooter rides?
yeah, like as it expands, the definition is difficult. So I think, Matthias, you're right. I mean, if it's just exchangeable for a ride, which Sarah pointed out is exempt from HST anyway, because it's municipal services. So you can use the tokens to pay on the
Okay.
Yeah.
Interesting.
and you can give them to poor people. So it's a good question. I think right now they are probably not cryptocurrencies or virtual payment instruments for purposes of the HST definition, but they could get there if the TTC took very specific steps in the right direction.
So if it were more like the payment service that you can use for the public transit in Hong Kong, for instance, where I can use it to buy dim sum or go to 7-Eleven or do other things, but also it's just the same card that I tap for my
Yeah.
Metro Pass.
Yeah, like if the TTC created a TTC currency, right, TTC bucks,
Right.
that could
Yeah.
be used for rides and other things, and was a digital representation of that money. There was a digital representation of that money on a card, and it was distributed publicly on a ledger using blockchain technology.
It's a lot of ifs.
Yeah, we would get there.
I think the headache here is also more for the issuer. You know, if you are just an investor, oftentimes, you know, the security token or utility token, it doesn't really, matter to you. The headache is more for the corporation that's issuing it. You know, it's high stakes on what it is and its treatment. So.
Agreed.
Fair. I want to ask a question about something that's completely different at this point, which is the automatic exchange of information tax rules, and how these might affect the disclosure of personal or financial information to governments in connection with transacting in digital assets.
Yeah, sure. So I think, yeah, because this is a compliance forum, I think this is an important aspect of the intersection of tax, cryptocurrency, and compliance. So what are the rules that require, so, we live in a voluntary self-reporting kind of system, not like in some European countries where the government actually fills out your tax return for you. We have to fill out our own tax returns. So what is it that makes you come forward and report your transactions and holdings in digital assets? So before even we get to these multinational and bilateral, transnational exchange of information regimes that Amber mentioned, just under domestic rules, we have an obligation to report so-called specified foreign property. If you have specified foreign property that at any time in the year, the total cost amount of it is over $100,000, you have to report that on a specific CRA form. And the penalty for not doing so is not that huge, it's $2,500. And ironically, if you fill one out, but you leave something material off it, it's $24,000. So it's a bit of an incentive not to report if you not to file this thing if you are so minded. But I mean, what's interesting about that is that you might hold $12,000 of cryptocurrency, but if you hold $89,000 of US dollars in a US bank account, that the cryptocurrency is probably intangible assets. To be specified foreign property, it has to be, again, this assuming it's property, but it has to be held outside of Canada. A real question, if your keys to the cryptocurrency are on a hard wallet that you have at home, or you wrote the key out by hand, where is that Bitcoin located? And what is the Bitcoin? Like, it's not the key, right? The key is gets you to a transaction on the ledger. So where is that situated? The cloud's on a bunch of servers worldwide. Conservatively, you'd probably say it's outside of Canada. In some cases, maybe you can establish that it's held in Canada, maybe with on a digital wallet of an exchange in Canada. So kind of murky, but that might be a reporting obligation. Let's say you don't do that. Let's say you don't report it there. So that was the voluntary part that we talked about. Is there stuff that's out of your hands? And I think there is. So if you have, you may recall, some of you might be even too young to recall this, but about, I don't know, 8 years ago or something like that, there were some Swiss whistleblowers at Swiss banks that told the US government that there were a lot of high net worth clients that their banks were helping to hide assets from the IRS. Like, millions and millions and millions of dollars, like a lot of money. And the IRS got pissed, and they basically got the Congress to pass a law called the acronym is FATCA, which is not accidental. It sort of sounds a bit like fat cat. And this was a way, a sort of a carrot and stick approach to force non-U.S. banks and custodians, brokers, investment funds to disclose the accounts or fund interests of Americans in these non-U.S. entities, which really are outside the reach of the IRS. So what they said was, fine, we're not going to claim to legislate over you, but we're going to set up a situation where if you don't report your U.S. account holders to us, we will impose a 30% withholding tax that's not reducible by treaty on certain broadly defined U.S. payments to you. So very soon, the whole financial world got into line with that. And then Europe and other countries said, that's a great idea, let's adopt something similar, and that's the OECD Common Reporting Standard. And so Canada has bilateral agreements with over 100 countries, basically to say that when a Canadian invests in an offshore financial institution, that offshore financial institution has to report that investment to its authorities, and then they pass that information back to Canada, to the CRA. And so then the question is, well, that's fine, Matthias, you tell us that works, that's for banks, brokers, et cetera. What does that do with cryptocurrency? I don't hold it through my JP Morgan brokerage account. I don't hold it through my JP Morgan bank account. And so then the question is, the ways that it is held, are the exchanges, if you're holding it through, through a wallet made available through an exchange, does it fit the definition of a financial institution? And those are open questions that people are debating, and different exchanges take different positions on that. But that may be a way that, unbeknownst to a Canadian investor who maybe hasn't declared their holdings, that information comes back to the CRA.
Fair. A lead-in question from that, just because we're talking about things that are very influenced by the U.S. The IRS recently came out with a discussion of how forks would be handled. And so the idea that if you receive a forked coin, then that becomes a taxable event. Has Canada taken a similar position, and where do we sit in that regard?
So, no, I'm not aware of the CRA having thought about forks, much less addressed them. And so I think it's an open issue how it would be addressed. Maybe people could analogize to something like a stock dividend. If you hold a stock of a company and it, instead of paying a cash dividend, declares an in-kind, it issues additional shares, or if it spins off a division into a separate corporation and gives stock to its current stockholders of that new division, both those are treated as taxable events to the holder. I think the sort of the bedrock idea is it an accretion of wealth to you? And that's kind of the way people think about whether something is a taxable event for someone. And I think there are probably more nuanced views of what forks are from people that understand technically what's happening, the separation of the blockchain into two different codes, and some people accepting and some people not. So I could definitely be corrected on that analogy to stock dividends. I think airdrops are kind of interesting because while that is, if it has value, what's been airdropped into your wallet, so it could be seen as an accretion to wealth and therefore a taxable event. We also have a principle in Canadian tax law, which not all national taxes have, which is that you're not taxed on windfalls. So if you get an unexpected, something of value that's unexpected that you didn't pursue, you didn't make any particular efforts for, that's there's a few other conditions, but that's not taxable to you. So there may be room to argue that the airdrop is not taxable, although one of the conditions is that it's not it wasn't just not expected in this case, but it's not customarily expected. And CRA may take the position that airdrops by now are somewhat customarily, not necessarily expected in on this coin, I'm expecting to get it. But in this space, generally, you're not shocked.
Yeah, I've read the IRS note today. I thought that was aggressive. Recognizing full ordinary income on the fair value of fork, the value of the fork coming in. Because it's unexpected. You get a certain amount of token. You probably have to scramble to have it liquidated. There's probably, some sort of pricing somewhere that's probably not really accurate of current market condition. So I thought that was really aggressive. If I was to look at what CRA would do, I would say, if they were reasonable, and oftentimes they are, on a fork, you receive a certain amount of token with a certain valuation at that day, and if they were nice, they would probably let you, not realize this value at inception, and then defer this until it's sold. But obviously, when we look at a crypto transaction for tax purposes, there's always two components. There's always the initial transaction always being something that's more of an active component. Initial recognition, oftentimes, for advisory token or all those kind of income is always active, and subsequently, if you don't trade that often, you establish that new cost basis, and in the future that's going to be capital gain. So I think that's the reasonable treatment, and hopefully CRA will decide on that.
Fair. We're about at time for my questions, so I'm going to end off with one of my favorite questions and then turn it over for a couple of questions from the audience. But if there was one thing that you wish your clients knew about taxation and virtual currency, so the first time that I come into your office, what do you wish that I came in already knowing?
So this is a bit of a narrow one, but we've seen a few situations where enterprises have issued tokens and kind of signed up term sheets with VC investors, like institutional investors, and promised to structure the deal in a certain way. And I think, as Mo was saying, like for the issuer, it can really make a difference how you structure it. And sometimes we've seen people agree to terms that are going to lead to a bad tax result for them, but they've already gone quite a ways down negotiating it, and they could have had a similar economic arrangement with a much better tax result for them. So I think it would be, I know this sounds a little bit like self-promotion or promotion for our industry, but to try to consult early, even if it's on a just real, hey, quick call, what do you think of this? We're about to sign this up. Any red flags, that kind of thing.
Yeah. I see a lot of, Bitcoin maximalists or investors or, people who've done well coming in. They ask a lot of questions with their peers, and they come in with all those ideas. They're extremely confused. Oftentimes, we're all seasoned expert here in our own field. Our answer is going to be a bit more nuanced because, we can actually interpret it a bit better. One thing that I would say though is, if you're confused and don't be sitting and just don't be on the status quo. There's still a few things that could be done early, and it all comes down to wallet management. Like, for tax purposes, there's gray zone, that's fine. A lot of things could be done to reorganize your wallets, segregate certain assets. It is extremely messy for us to actually clean up, a deal where someone who's managing millions has one or two wallets, and all their activities are there. And there's syndication, there's personal deals, there's ICO deals, there's corporate deals in there. So I wish people would come to us and have us at least clean this up. Not the tax issues, but just at least organize their treasury in terms of having specific wallets for specific reason, and that's going to give you a lot more flexibility in the future.
I guess I have a very low threshold baseline for what I wish people know when they come into my office. I really just want people to know that GST, HST exists, and that it's like a serious tax that applies to things. When I was in law school, there were tax courses, but there were no commodity tax courses. I didn't know there was a field of commodity taxes, and I kind of fell into it as a practitioner. A lot of corporate lawyers who advise companies don't really know much or anything about GST, HST, and so I like it when clients know that it's a tax that's important to consider. But if they don't, of course, then it gives me something to do.
So, and I think this applies to this space as well as any other. I wish that clients knew that we have better solutions on Mondays than on Friday afternoons. Like, come early and talk to us about whether there may be an issue before you've done something, as opposed to when it's very late stage.
How about Friday on a long weekend?
Well, that's the best time. Actually, this dropped Friday afternoon of a long weekend. That is when finance releases important things. But yeah, I mean, give us a chance to work with you to find an optimal solution, as opposed to trying to patch something after the fact. And I think everybody will have a better result. Yeah, I think that's it.
That was a pretty strong theme across the answers, was get good professional advice and get it sooner rather than later in your process.
And
I
I
hear
know
that.
from speaking to the panel members that we all love the exchange of information going the other way, like learning from the clients. It's such a fascinating field. You guys know a lot more than we do about a lot of this.
Fair. I'm going to hand it over to audience members for questions.
Hi. So going back to the comment that Zvi made earlier, so we talked about crypto from a trading or payments mechanism perspective. If I go back to the origins in terms of the Bitcoin example that you used, and if you're in a situation you're mining Bitcoin, and if I compare this sort of just similar to like gold mining, like what are the tax implications from both direct and indirect tax point of view? Like, is it considered taxable when it's generated or when you actually sell and convert it into fiat? So probably Zvi or Mateus, like anybody.
Yeah, and I'll let Sarah speak to it as well, because
She's a better mic.
she no, because she mentioned that she deals with miners. But just on the precious metal point, the way miners work in the real world with mining in the ground, there's a very special rule for GST that when you are engaged in industry of mining, and you are digging ore out of the ground and refining it into a precious metal that then becomes a financial instrument, you still do get input tax credits. So even though you're not selling something that's taxable, you're selling something that's a financial instrument, but that's the end result of your work. You actually spent a whole lot of industry and work and expense on getting it out of the ground, just like anybody else in industry spends expense and industry doing manufacturing or whatever. And so there's a special rule that deems the very first sale of a precious metal by a person who refined it or who dug it out of the ground to be not exempt from GST, but also not taxable in the sense that you have to pay tax. It's what's called zero rated. So it's taxable at a rate of 0%. Miners of Bitcoin don't have a rule like that. And I know people have complained to the Department of Finance that they should, because why not? They are also in an industry expending resources and money and expenses, and they're creating a financial instrument from scratch. Shouldn't they also get this special treatment that the first sale of a Bitcoin or whatever cryptocurrency has been mined should be not exempt, but zero rated, and then the miner can get full input tax credits for all of their input costs, all of the GST, HST that they pay. And that didn't go anywhere. So what we've got here with the draft legislation is just a pure exemption. And Sarah mentioned that there's really just no guidance for miners. So, I mean, what does that mean? It means that on its face, I said to Sarah before, on its face, it looks like miners are engaged in creating financial instruments It's just like a bank sort of syndicating a bunch of loans. They don't get input tax credits for any of their input costs. I know Sarah has some creative thoughts
Yeah,
about that.
so this is where a touch of elegance sometimes is required, but what we've seen miners do when they're setting up is to make that first sale to a non-resident so that they get that 0% tax treatment, and then from there it goes into the ledger and it goes where it goes. But on the face of it, there are two ways I think that you could look at what a miner is doing. They're either creating what is now defined to be a financial instrument, or they are possibly providing a service to somebody that results in the creation. So if you think about the precious metal analogy, you might be refining for somebody else. So somebody brought it out of the ground and you're just the refiner. There is no guidance at this point. This proposal came out in May, and there's a big black hole in terms of how it impacts miners. Obviously, there are a lot of miners in Canada who are already operational and claiming input tax credits or taking whatever positions they've taken. And the retroactive application of this can impact them as well. Maybe they have a change in use of the property that they've brought into Canada. We don't really know. This was open for comment, so Finance was accepting comments for about a month. So if you happen to have read it in May and thought about it and submitted something by mid-June, they may now be considering it. With the election, we're not, none of the parties have really put anything specific in their platforms dealing with this. There's not really any commentary or guidance or hints as to where it will go next.
Yeah, real quickly, so we probably need to get onto other questions, but assuming that the miner is like it's their business, like this is what they do as it's a concerted, structured activity frequently. If it's the kind of mining where you get cryptocurrency as a reward for solving these problems, the CRA would consider that to be revenue as ordinary income, and so have to include that in income, and you get to claim deductions as well.
So if I go back to sorry, I'll follow up question to that. So here I'm gonna hit you back. So if I think about this from the perspective like a gold miner,
Yeah.
so if they have mined gold and it's sitting on their balance sheet as inventory,
Yeah.
they won't be taxed
No,
until
they
they
wouldn't.
realize
Absolutely,
they sell the gold,
Yeah,
right?
yeah.
So if you think about it from that perspective,
Yeah.
and if you look at a Bitcoin miner, they're almost sort of, paying
what you're saying
taxes
makes more
from
sense.
What they generate.
Yeah, what you're
So
saying makes more sense.
It doesn't sort of align from that point of view. Like a mining operation is kind of burning their treasury to fulfill the CRA's obligation.
Yeah.
Shouldn't be like the other way around. Like the tax should follow accounting, and accounting right now is not clear.
Yeah. It doesn't always follow accounting, but you know what? You could certainly make an argument.
I hate to piggyback on exactly where you were, but from a mining perspective, Bitcoin is mining, and then there's the next iteration, which is proof of stake. So from that perspective, the two parts that I kind of have for that question is, you're quote unquote mining in a proof of stake version, but also there's a transaction fee because you're taking in somebody's, say, delegation,
Yeah.
and earning a reward, air quotes for the camera that can't see me, reward for that. So is there a distinction between the proof of stake mining version of that answer, and is there a difference between the reward that comes in for that as well?
So can you remind me, in the proof of stake model, what is the compensation or incentive for the miner to do the mining? Are they getting tokens? Are they getting?
Yeah, basically the very quick difference is that instead of doing Sudokus to get the reward, that Sudoku is a lot easier. It's more about holding an asset in trust, say,
Right.
but not custodially. Anyways.
Custodially, yeah.
Yeah. I
Yeah,
guess that's
I'm not sure it would be different.
Is anyone else able to answer that more concisely?
Yeah, so essentially, if you're staking and essentially validating blocks of transaction on a chain, it's clearly active income, okay? And it really acts really like you're earning almost like interest. But I would say the treatment for me would be to tell you, as you earn your staking revenue, those are brought into income as active, and those are brought into your inventory, and now you establish a new cost basis. Yeah, so to me, the staking issue is pretty simple from an accounting perspective. You know, obviously a bit different from the mining challenges and how they account for inventory. But yeah, that, you know, does that answer your question?
Yeah, further to that is when, you know, how do you determine when the value of that newfound token,
Yeah.
that earned token, starts at $1? You know, does it,
Yeah.
implication started, you know, the day that it was earned?
Yeah, so there's different way of looking into it, and I mean, this, you know, for you, when you stake, you receive income, right? As they go in, use the fair value, apply that exchange rate, and that's your new income coming in, right? Don't accrue anything, use cash basis, that's fine for now, right?
Question on fork. So if a blockchain fork and you receive the token on your wallet because you own the other fork, other chain, and then eventually you sold the newly forked coin, is that treated as a capital gain with a zero cost base?
I think it would be treated as having zero cost base, and whether it was treated as capital gain or not, you know, likely, like the default that CRA would have would be to look at the transaction, like how you were holding the other coin, you know, before the fork happened, whether you were holding it as a trader or more as a long-term investor. They likely would treat the forked property the same, unless you could establish that, you know, your intention with regard to the forked coin was vastly different from the other one.
Okay, and if it's an airdrop, and when they drop to your account, it already have a value that probably trade as say $1, and then later on you sold it, and do you have to say that the $1 trade as an income? Then the anything beyond the $1, when you sold it, you treat it as a capital gain?
I'm not sure exactly what you mean, but I actually want to go back to the previous question.
Okay.
I realized we mixed something up.
Oh.
I don't think you'd have a $0 cost basis, because you'd be taxed if the IRS is correct that you're taxable on it at that time. So you'd have a full fair market value cost base on what it was worth, the valuation on the day that the fork happened of the new, you know, Bitcoin Cash or whatever it is. So you should have some basis in it.
Okay.
Okay, and your second question, could you repeat that, please?
The second one is one airdrop in your account, and let's say when you airdrop, the token has $1, and later on you sold more than $1. So is that $1 considered as income, and then anything beyond $1 is considered capital gain? Or?
No. They probably
let me ask you a question. So are you a day trader?
No.
Okay,
No.
so again, so if you're not a day trader,
Yeah.
initial recognition of airdrops would be active income, $1 as active, and then ongoing, because your whole portfolio is more capital gain in nature.
Right.
You have established a new cost basis of $1, and if the token happens to be 50 cents in 6 months, you have a capital loss for that amount. So initial recognition, active, and then going forward, because of the nature of your activity, it would be considered capital gains.
Okay,
or
but then
losses.
that means that whoever drops something in your account, is somebody force you to have income?
Mhm.
That's
Yeah,
that's
a
why
bad
people are
problem.
mad about the IRS's the IRS's position, because it's sort of forcing you to have a taxable event when it's not in your control. But there's other situations like that.
Did I understand this correctly, that exchange is supposed to charge HST when they sell cryptocurrencies on top of the price of the currency?
That was worth standing up for.
Actually, that was scary to me too, to hear, but I guess it's in the current legislation, potentially.
There you go. So now that the new definition of virtual payment instrument has been provided, it's not in force yet, but we know what it is, and we think that it's going to be retroactive to May 18th, 2019. The cryptocurrencies that we're talking about, the main ones that you would exchange on an exchange, like Bitcoin, Ether, Poly, I don't know about whatever. Yeah, those would be the kinds of virtual cryptocurrencies that are exempt, and so you would sell them exempt from GST, HST. Before the legislation came out, based on the CRA's guidance that it was a commodity, it looked like the CRA's position would have been, if anybody had asked them directly and they gave a direct answer. I know people asked them, and I think they spent a long time writing their responses, and it took them so long that the legislation came out in the meantime. I think they likely would have said that it is taxable, because I've seen a Q&A where we had a roundtable with the Canadian Bar Association, where they said, if it's not considered money, if bitcoins, they were speaking about bitcoins again, if bitcoins are not considered money, and we think they're not considered money, because the definition of money includes currency, and we think currency only means a currency issued by a government, we think it would be considered intangible personal property, and which is subject to GST, HST. With exchanges, I think there is a question whether the exchange is selling on its own behalf, or whether the exchange is matching people who are actually transacting with each other. And depending on the terms of service of the exchange and what the exchange actually says it's doing, and legally the legal relationship between the people who are exchanging on the exchange and the exchange itself, you could have an argument that the exchange isn't selling bitcoins to anybody. The exchange is actually creating or brokering transactions between people, and you don't know who those people are because they're anonymous, right? That is a possibility for at least some exchanges, but I think there are exchanges out there that buy and sell on their own behalf, and if they do, then you've fallen into that issue that the CRA says it's a commodity, that, again, before the legislation comes out. It's a commodity, it's taxable. You still have the argument that they're wrong, and it's a relatively good argument, because their idea that a currency only means a currency issued by a government isn't based in any legislation. It's their interpretation. But that is the administrative position of the CRA, we think.
Okay, and a quick question. When I buy Bitcoin and I hold it, at what moment do I need to pay taxes? Only when I sell it, or like is there some way in between? Like, how does it work?
Do you mean HST?
Anything,
income
capital
tax?
gains, income, HST, whatever. like-
HST is when you buy and sell on the time you have the transaction. And in addition to the purchase price, when the consideration is payable, HST is also payable. Income tax is
So if
different.
I hold, I don't pay until I sell Bitcoin for dollars, am I correct?
That's right. That's right.
And if I lose the private keys, is it a capital loss?
Yeah, it
That's a
should be.
good question. That's like throwing your safe into the sea, and so you've lost all your money.
Yeah. I mean, so what you need to claim a capital loss, you need to have a disposition. So you would need to establish to the CRA that, that like it's gone, right? Like, and so that could be tough. But if you could do it, I've never actually thought about that, but having your house burned down or having it be expropriated, those are dispositions. So having, like having the exchange go bankrupt certainly would be, not a great thing to happen, but much easier to convince the CRA that you have a capital loss in that situation than if you say, oh, I had the key written down and I can't find it. They might kind of go, well, maybe it's going to turn up. But if you can establish it, yeah, you should have a disposition. No.
Well, this is actually the biggest risk. People lose
Yeah.
coins.
People die and their families never know, right? Like that they had, yeah.
Okay, I think we've got time for maybe one more.
Do you guys have like real case experience with your customers, maybe anonymous, whatever, who lost quite a bit on quadriga exchange? In terms of taxes and stuff, like how do people deal with that?
I mean, I've been involved. We've been involved with that quadriga exchange, but not with the investors, more with the exchange.
It's an interesting one, right? Quadriga, everybody knows the story, unfortunately. Obviously, you have a loss. You can claim that loss, and it's a case by case. So we'll have to take a look at, your personal situation. Most likely than not, again, most likely than not, it will be probably a capital gain, capital loss kind of situation. But you will definitely have some sort of, loss to compensate for past or future gains. Yeah.
Okay, we're gonna sneak in one more actual last time, and I know there's a couple of other hands. Can I encourage everyone, our panelists included, to hang out and exchange information, because I know we've all got lots of questions.
Sure.
I'll keep this short. When you're trading tokens, often you can't trade tokens against dollars. You have to trade them against Bitcoin. And so if you're trading a token against Bitcoin, how do you go about, assessing the value at that moment? Do you have to convert the gain or loss of that transaction through the price of Bitcoin at that very moment into dollars? And then, is that how you would?
Yeah, exactly. So you have to go back to, so let's say you're selling Ether, you're exchanging Ether for Bitcoin. So you go back to when you acquired the Ether. Let's assume you acquired only in one block, and you figure out what was the Canadian dollar value on that day, right?
Just kind of roughly, because obviously fluctuates throughout the day too.
Yeah, I mean, maybe you paid a certain amount plus some commissions. Maybe you still have the record of that, but otherwise you just go back to historic data, and so you do the exchange on that day for your cost amount, and then to figure out what your profit was, you say what's the Canadian dollar value of the Bitcoin that I got in exchange.
Okay.
And the delta between those two will give you the gain on your Ether.
Right. And do you guys deal with personal taxes in trading like that?
I think Sarah's colleagues would, right? Like personal
Yes.
income tax.
My friends down the hall would. certainly.
Refer us to
Yep.
somebody, yeah?
Yeah, absolutely.
The other bit that I think I read, if I'm not mistaken, is the idea that whatever rate you're using should be relatively consistent. So the idea that I shouldn't be using Kraken today, but then if it's more favorable for me to use something else tomorrow as my conversion rate.
Yeah, so I was going to say, I mean, this comes up with GST. When people are using GST for legal services, there's actually a law firm out there, Bitcoin for legal services, or another cryptocurrency. There are law firms that actually accept cryptocurrencies, and not just law firms, of course, other service providers. There you go. Amber does. So you have to collect GST, HST on your services, right? And you have to remit it in Canadian dollars because CRA doesn't accept cryptocurrencies yet. And so the question is, well, what exchange rate are you going to use in order to exchange it? And so I guess maybe that's where you've come across that guidance. With foreign currencies, there are actually rules. You can use the Bank of Canada exchange rate averaged over the past month, or you can use the exchange that you got, the actual exchange that you got at the bank. But with cryptocurrencies, because they are considered to be a commodity by the CRA, it's spot pricing. You have to use fair market value at the time that you receive the consideration. And so if you can get like I've never seen an audit of this, but like ideally they would want a time-stamped value. If you did the transaction at 12:01, then what was the value at 12:01? Not always practical, and so the practical answer might be to average over the day, but that's the law hasn't caught up with cryptocurrencies, right? So.
I think we've got to end off there just from a time perspective. Please give these guys a big hand. And like I said, stay, hang out, ask questions. Thank you so much.
Thanks, everyone.